Good morning, everyone. You are watching live Daily Market Outlook for Tuesday, 8th of January 2013, prepared by Windsor Brokers. This single currency holds its near-term positive tone after finding ground at 130 yesterday, with the risk on mode again coming back in play. Euro remains supported as it's bounced from 130, regained the important 130.88 and 131 barriers, still struggling to clear some important levels at 131.40.50, but overall the near-term structure keeps the focus at the upside. The top news from the Asian session came from Japan, as the announcement by Japan of its commitment to purchase ESM bonds to help stabilize Europe pushed the yen pushed the yen higher against the dollar, and this is the third day of the corrective action of dollar yen following a strong couple of weeks rally that peaked at 88.40 last Friday, and currently the pair is holding at around 87.40 level, cracking the important 87.35 support, with the technical outlook still seeing more potential for further retracement, as the profit taking pushed the dollar against the Japanese yen off its recent highs, the highest levels since July 2010. From the other side, the German imports that were released today unexpectedly slumped and exports slid, while French data showed some more positive, trade balance showed some more positive tone compared to the forecast, but still keeping the euro in red. From today's calendar, not many events, as we are in the week where the major releases are coming. The central banks of UK and the Eurozone and European Central Bank are due to release their monetary policies, with the expectations for the central bank, European Central Bank, to hold the rates unchanged, and the releases are due on Thursday, if I'm not mistaken. We're going to check it again. Let's first take a look at today's calendar. We have already seen releases from the trade balance from Australia that showed further increase of the gap to minus 2.6 billion Australian dollars compared to minus 2.3 billion forecast, but still below the previous October's release of gap of minus 2.9 billion Australian dollars. I do apologize. The Swiss unemployment rate for December monthly release came along with the expectations and below the November's release of 3.1%. 3% is the December's unemployment. As said, German trade balance shows 14.6 billion euros surplus, below the forecasted 15.9 billion and the 15.2 billion of the November, while French trade gap improved from 4.7 billion gap in October to 4.3 billion euros in November, and minus 4.8 billion as today's forecast. Still to come, retail sales from Eurozone due at 10 o'clock GMT. Improvement by 0.5% is seen on today's forecast compared to drop in October by minus 1.2%, and the European unemployment rate at the same time is expected to increase to 11.8% according to the forecast, compared to 11.7 in the month of October. German factory orders are due at 11 o'clock GMT, and the negative forecast is seen for today, minus 1.4 compared to a healthy 3.9% in the month of October. Significant decrease according to the forecast. And from states at 1500 GMT, economic optimism for January is seeing that economy is picking up. According to the forecast, 46.3 is consensus for today compared to 45.1 in the month of December. And late in the afternoon at 20 GMT is the consumer credit from United States for November, 12.1 billion US dollars, below the October's release at 14.2 billion US dollars. And we're going to take a look now at the technicals, as most of you are waiting to see the latest movements and expectations for the major currencies and the commodities. As always, we start with the euro. Let's just see if you see the chart. Okay, hourly chart shows the recovery of 130.00, very strong and psychological support that basically cleared the important 130.88 last Friday's intraday high, and 131.00 as psychological resistance, and the close above these levels keeps the focus at the upside, with the hourly indicators, hourly studies still holding the positive tone, and price holding mainly above the 20 and 55 days exponential moving averages, seeing some room for a possible extension higher. However, we need to see the clearance of a quite strong barrier at 131.50.60. We have the 50% retracement of the down leg from 132.98 to 129.96, and the previous consolidation range floor at 131.60 zone. A break of these two levels is seen as a accelerator for a possible further extension higher, and to avert immediate downside risk of revisiting 130.00 with the 132 to come in focus. Basically, this recovery could travel up to 132 easily once 131.50 is cleared. On the downside, immediate support lies at 131.00 as the price is close to these levels, reinforced by hourly 20 days exponential moving average, and of course the previous high at 130.88, expected to contain, ideally to contain any reversals in order to keep the immediate bulls of 130.00 in play for a possible extension higher. Otherwise, loss of 130.88 would risk another test of another important 131.50 that marks approximately 61.8% retracement of the recovery rally from 129.96 to the highest seen overnight at 131.38, and basically break below this level is set to shift the focus again towards the downside. As we said, our hourly structure is still holding positive tone, although we have to be cautious with the 4-hour chart indicators that are still all pointing higher, but confirmation is required on a break above initially 131.37, that is the 55 days exponential moving average, and the 131.50.60 that marks the 50% retracement and the previous range floor, along with the Fibonacci expansion 38.2% of the way from 130.00, break above 131.60 to confirm the recovery. Of course, the focus remains on the ECB's decision later in the week, and most of investors are waiting for the signal what the European Central Bank is going to do. The British pound against the dollar remains in the corrective mode of recent low at 160.08. 160.00 offers quite strong and psychological support, also previous lows, with the recovery so far hitting levels at 161.26. Close above 161, stays close above 161, keeps some, in a way, positive tone, but the pair lost traction at the beginning of the European session, and they lost 161 handle, dipping as low as 160.77. Basically, this was cracking the previous high of yesterday at 160.81, and more important is daily Ichimoku cloud top at 160.67. And if we lose these two supports, then the immediate risk will shift towards the downside again, towards 160.00, and there will be signal for further extension of the recent steep fall from 163.80 peak of 2nd of January 2013, and will open way for a possible further retracement of the rally from 158.26 mid-November low to 163.80 2nd of January high, with the So 168.08 seen so far. This is also the previous low of 7th of December. Break of these levels to open 159.60. That marks 76.4% retracement. Also, it's the previous low of 28th of November 2012. As said, near-term structure, the hourly indicators are losing traction, and as we see the loss of initial bullish momentum, with all indicators now pointing lower, increase the immediate risk towards the downside, while the 4-hour structure shows the indicator still in the negative territory, although pointing higher, but reversal is already evident on the RSI, that is breaking below the 7 days, 7 days moving average, and the stochastic is already breaking below its a line that is signaling a possible further weakness. A break below 160.65 is to signal lower top at 161.26 and signal the end of near-term corrective action of 160.00 that basically failed to clear some important levels. Among them is 161.41, that is 4-hour 55 days exponential moving average, and then we have 150 that marks 38.2% retracement of the down leg from 163.80 to 160.08. Basically, if we see the break above 161.50, then we might be talking of revisiting and further extension higher, revisiting 162. This is close to 50% retracement, and this will avert immediate downside risk of retesting 160.00. Dollar yen remains in the corrective mode of 88.40, recent peak posted last Friday, as basing attempt at 87.60 seen last Friday and yesterday, where the temporary support was found, failed to clear important and psychological 88 barrier, with subsequent weakness through the previous low 87.60, cracking important support at 87.35. That marks 38.2% Fibonacci retracement of the uplift from 85.64 to 88.40. Also previous high posted on 3rd of January at 87.35. Cracking this level sees more risk towards the downside. Basically sees potential for further retracement of the latest uplift from 85.64, with 87.22 seen so far. This was in the early hours of the Asian session. Hourly structure remains negative and keeps the focus at the downside, with the additional pressure put on the bearish crossover of 20 over 55 days exponential moving averages at 87.66, with the 10 days one maintaining the bear so far. 4-hour structure indicators are in descending mode of from the overbought territory, and also signal good potential for some stronger reversal, as there was an obstructed rally from beginning of December from 81.71 that peaked at 88.40, and some stronger corrective action could be seen on this point. Also, the pressure on the dollar yen is accompanied by fundamentals, as we mentioned at the beginning. Announcement of Japanese government of buying ESM bond is aiming also to stabilize the Japanese currency, and basically break below 87.35. 20 is to open 87.00 as the next psychological around figure support, and the 50% retracement of 85.64 to 88.40. And then we have another strong support. 86.75 is the low of 3rd of January, and 86.69 is the 61.8% retracement. Basically, if we see the break below these levels, then a stronger reversal could be anticipated, and the temporary top will be confirmed at 88.40. Daily structure on dollar yen is showing the indicators strongly in the overbought territory, with the reversal already being evident that RSI is pointing lower, stochastic is pointing lower, momentum is now in descending mode, signaling that some corrective action, stronger corrective action is not ruled out at this point. And finally, this with dollar Swiss. It's attempting basically it's attempting to base at 92.00, but a recovery from 90.80 double bottom, better seen on the 4-hour chart. We can see it here, that reached 93.00 originally, failed to break this level, and a subsequent reversal, and with formation of a failure swing at the lower top at 92.85, now sees more risk again towards the downside, with the near-term basic attempt, as we said, seen at 92.00. This is close to 50% retracement of the rally from 90.77 to 93.02. Unless we see the break above 90, minimum 92.50, that marks approximately, we just put the approximately 50% retracement of the recent down leg. That will avert immediate downside risk. We still see potential in case of failure to clear 92.50, as I said. More risk is again seen towards the downside, as the fresh leg lower may target levels below 92.00, with the 91.89 seen as a 50% retracement, and the static supports 91.69 low of 3rd of January, and the 61.8% retracement at 91.63. This is also accompanied by the previous range top at 91.80. Basically, if we see the break below 91.80, 91.60, then the focus will shift again down towards a strong support zone at 91.00, 90.80, and will be signal for a further extension of the larger downtrend that moves from 99.70, 24th of July, yearly peak for 2012, especially that the upside so far being capped by descending bear trend line of 99.70, as well as 55 days moving average, and unless we see break above 93.00, more risk is still seen towards the downside. Conversely, break above 93 is to open previous high at 93.81, and the 94.00 is psychological barrier ahead of 200 days moving average, currently at 94.26. From the energies, crude oil holds near-term positive tone. Basically, it's in the sideways mode, consolidating recent gains that peaked at 93.83, with the rather neutral tone seen, but a neutral to positive tone seen on the hourly chart, as the price reversal of 93.80 found support at 91.50, 200 days moving average, as shown on the daily chart, with the quick bounce higher, keeping the upside in focus for now. Also positive structure is seen on the 4-hour chart that keeps the upside still in focus, as the oil price hit our initial target at 93.85, Fibonacci expansion 138.2% of the uplift from 85.20, with the further expansion higher seen quite likely, as long as 91.50 holds towards 160, towards 95.00 as around the figure and psychological resistance, and 95.33 is the 161.8% Fibonacci expansion of the uplift from 85.20. On the downside, the immediate support, dynamic support, is at 92.86. It's the 55 days exponential moving average, and the static support at 92.43, while any dip below 91.50 could be seen as increasing downside risk and the possible further reversal. The traders are expecting the data from Chinese GDP is due to be released, and expectations are widely seen towards an increase to approximately 7.8%. That gives additional, that would give additional boost to the energies, as China is the second consumer of the energies in the world, and the investors will be monitoring basically the Chinese data, trade data, and the GDP that are due to be released on Thursday. And finally, the yellow metal holds some positive tone of recent low at 25, as temporary support was found at 1642, and the gold ticked higher, hitting overnight's high at 1648. But generally, overall, the near-term price action is still under heavy pressure as negative hourly studies and also 4-hour indicators in the negative territory see again more potential towards the downside as the price continues to dip lower, with the latest marginally lower low at 1625 seen so far after breaking a previous low at 1635. Negative tone, as said, still favors the downside, with some corrective action seen so far limited at 1660. That marks 38.2% retracement of the down leg from 1723 to 1625, and this is also descending 55 days exponential moving average. Any bounce above 1660, 1670 would improve the near-term structure and allow for some stronger recovery, but still stronger barriers at 1700 zone, previous high at 1693, and the trendline resistance at 1683 are still keeping the downside pressure, basically keeping the upside limited. A break above 1680, 1700 is to provide relief and allow for some stronger corrective action. Otherwise, extension of the larger downtrend from 1795 2012 peak from October 2012 sees more potential towards the downside, especially that the price broke below 200 days moving average that is currently limiting the corrective action of 1625, and the price met our initial target at 1628. Basically, this was cracked by dipping to 1625. Fibonacci expansions 100% of the wave from 1752 at 1628, with the next downside targets seen at 1600 as round figure support, and the 1580 Fibonacci expansion 138.2% of the down move from 1752. And that will be all from my side. Please, your questions are to be submitted right now. Do we have any questions for today? No? Well, that's amazing. Anyway, if no questions, then I would like to thank you all for being with us. Expect to see you again tomorrow at the same time at 8 o'clock GMT, 10 o'clock local Cyprus time. Until then, I wish you a very nice day and, of course, very good and profitable trading. Good luck.